Welcome to the first ever Hangout on the Union Budget.
Thank you. So let's get on to Jahangir Aziz, Senior Asia Economist and India Chief Economist at JP Morgan. Jahangir, yours.
Good evening, FM, once again. Let me just reiterate something that Senthil said at the beginning. Not too long back, back in, I would say, early September, we were in the financial markets, would sit around and, basically be essentially scared of a runaway deficit, the rupee dropping like a stone, the current account deficit widening. We had already seen 2 months of negative outflows. And then, last week you presented a budget outturn of 5.2%, and just to reflect the change that you brought about, you and your team, we basically shrugged it away. So I think, congratulations are due to you and your team, FM, that you managed to take us, avert this very devastating event of a credit downgrade, which could have completely changed the situation that we are in right now. Having said that, FM, and I agree with you completely that we compare ourselves to our own past. We look at the 9% growth rate, the 3% current account deficit, and we look at where we are right now, and we say, things are really, really bad. And what we don't do is to look at what's happening around the world. And almost all of our emerging market peers, from Turkey, Brazil, South Africa, Indonesia, Malaysia, all of us have either seen current account surpluses fall very sharply or current account deficits rise very much. But the concern, FM, is that nowhere or no other country's currency, people aren't very much nervous about any other currency but the INR. And the concern is that perhaps you might want to look at other forms of sticky money to come and finance it. Again, it's a short-term fix. So the question, FM, is that whether there are other forms of sticky money that you are looking into.
Well, I don't know what you mean by sticky money. We have to get inflows into India. FDI, FII. And to the extent that they are not enough, and to the extent that we can service them, we have to get external commercial borrowing. Now, thanks to remittances made by Indians abroad, the current account deficit is at a certain level. If these remittances were not there, the current account deficit will be worse. Our problem is peculiar. Our problem is we are dependent on some crucial imports to keep India going. Oil, crude oil, edible oil, pulses, now coal. Despite abundant reserves of coal, we are importing coal. And then, of course, capital goods, etc., etc. And then this one thing which we can do without, gold. Now, what do? I can appeal to the people. If we do not import gold for 1 year, half our current account deficit will disappear. We have to get real money into India, which is why I emphasize FDI, FII, and to the extent we can afford it, ECB. I don't know what Jahangir is talking about. What other money is he talking about?
Jahangir, would you like to tell us what you mean by more sticky money?
What about opening up our debt markets a little bit more to foreigners? Because that would allow us to get one avenue of money that we haven't really got so far.
Well, Jahangir, you know that the debt market is open to foreigners, but there are limits.
Right.
Our debt to GDP ratio is a ratio that is watched around the world by analysts. Then the quality of the debt. Is it concessional debt? Is it short-term debt? Is it long-term debt? Then our capacity to service the debt. Interest as a proportion of export earnings. All these ratios are watched by analysts. So while we try to fix one problem, we should not create other problems. I'm aware that we can liberalize the debt market by allowing more foreign money to come into the debt market. In fact, we have liberalized it. We've raised it to $75 billion. There are some sublimits. We are examining whether these sublimits can be removed and all these can be made fungible. We're examining that. We also have to keep in mind the sensitivities of RBI. RBI will not allow complete opening of the debt market because that has consequences for monetary policy management. We are aware of these issues, but we have to go about it in a very careful, calibrated manner. We simply can't throw open the door and say, whoever wants to invest in debt in India can do so. We must have the capacity to service the debt. Take, for example, an Indian company. Can we allow it to borrow indiscriminately or without limit in foreign currency if it has no foreign exchange earnings? How will it repay the debt? It will come to the Reserve Bank and say, please give me foreign exchange. Our reserves are only $300 billion. It seemed large at one point of time, but with the size of the current account deficit, the reserves are not very large. If a company has got a stream of foreign exchange earnings, then you can allow it to borrow in foreign exchange. But if it does not have a stream of foreign exchange earnings, do you allow it to borrow an unlimited amount? Take infrastructure companies. If you get foreign currency debt into infrastructure, most infrastructure doesn't earn in foreign exchange. How will they repay the debt? So I think a number of things have to be balanced. I mean, Jahangir knows that we have to balance it very, very carefully so that fixing one problem does not throw up greater problems.
But FM, you do have a very large borrowing program this year. Are you concerned that if your wish comes true and India actually starts recovering, that won't put pressure on lending rates?
We don't have a large borrowing program. This is again someone who didn't look at the numbers carefully, said it on television, and then everybody picked it up. In 2012-13, net borrowing is 4,79,000 crore. Next year, we are borrowing exactly 5,000 crore more, 4,84,000 crore. Net borrowing is increasing by only 5,000 crore. If you look at gross market borrowing, 2012-13 is 5,69,000 crore, and in 2013-14, it will be 5,79,000 crore, just 10,000 crore more. I think somebody got one number wrong. There's another item, 50,000 crore. That's not net borrowing. That's simply loans that we are taking, which will be rolled over immediately. What we are trying to do is avoiding bunching in the year 2015-16, 16-17, and 17-18. We don't want the redemptions to bunch in those 3 years. Therefore, we are borrowing 50,000 now. I mean, redeeming some of that and then lending it again. That's purely an accounting entry which will cost us a small interest cost. Otherwise, the borrowing, both gross and net, are well within limits. In fact, this is the smallest increase year upon year.